China didn't crash the market. It quietly pulled back. Since 2013, China has reduced its U.S. Treasury holdings from about $32 trillion to under $700 billion. That's more than $600 billion no longer recycled into U.S. debt. At the same time, global dollar reserves stopped growing the way they used to. Central banks slowed accumulation. Reinvestment assumptions broke. In total, more than $5 trillion in global capital changed behavior. Not sold in one trade, but no longer coming back. This didn't cause a crash, it caused pressure. And this is how reserve systems actually begin to fail. Something feels wrong, not emotionally, mechanically. And if you've been watching markets closely, you've probably felt it too, even if you couldn't quite name it. Markets are still open, trades still clear, payments still settle. Nothing looks broken on the surface, but the system no longer feels effortless. And liquidity used to feel automatic. It doesn't anymore. Let's start with something simple. The United States is running deficits of over $2 trillion a year. Not once, not during a crisis, every year. In 2020, that was understandable. In 2021, still expected. By 2023 and 2024, it became structural. That means trillions in new Treasury issuance that must be absorbed by someone. For decades, that someone was obvious. Foreign central banks, China, Japan, oil exporters, surplus economies recycling dollars back into U.S. debt. That recycling was the lubricant of the system. It made deficits feel painless. But that recycling is slowing. China's U.S. Treasury holdings peaked at about $1.32 trillion in 2013. By 2022, they were already down hundreds of billions. By 2024, below $800 billion. By 2025, close to $700 billion. That's not a headline crash. That's a decade-long exit. And here's the key point. Those dollars didn't vanish. They just didn't come back into U.S. debt. At the same time, Japan is under pressure at home. The yen weakened sharply. Inflation re-entered a system built on low rates. The Bank of Japan was forced to adjust policy. And when domestic pressure rises, foreign asset accumulation stops being a priority. Now look at the other side of the equation. U.S. Treasury issuance accelerated. Net marketable borrowing exceeded $1.7 trillion in 2023 alone. Supply increased. But the buyer base did not expand with it. That gap has consequences. Not dramatic ones, mechanical ones. The 10-year Treasury yield moved from around 0.5% in 2020 to over 4% and even 5% in subsequent years. That didn't happen because investors suddenly got emotional. It happened because compensation was required. Higher yields are not panic. They are negotiation. At the same time, the Federal Reserve changed posture. Its balance sheet expanded past $9 trillion, then began shrinking. Quantitative tightening removed more than $1 trillion in reserves. Liquidity that once smoothed markets was deliberately withdrawn. Repo markets became sensitive again. Funding spreads widened intermittently. Treasury auctions began to show tails, not failures, signals. Bid-to-cover ratios softened. Primary dealers absorbed more risk. That tells you something important. The system still works, but it works harder. Now zoom out globally. According to IMF data, the growth rate of global dollar reserves slowed sharply after 2021, not because global trade collapsed, but because central banks changed behavior. They diversified. They paused accumulation. They questioned assumptions. Today, global foreign exchange reserves exceed $12 trillion, but the story isn't the size, it's the flow. More than $5 trillion in global capital shifted from automatic recycling to conditional positioning. That is the discomfort you're feeling, not a crash. A change in default behavior. When buyers stop being guaranteed, everything downstream changes. Debt becomes heavier, policy becomes reactive, interventions become frequent. And here's the part most people miss. Nothing has failed yet, which is exactly why this moment matters. Because systems don't announce transitions. They reveal them through friction, through pressure, through effort. This is not volatility. Volatility is loud. This is quiet strain. And quiet strain is how every major shift begins. This is not a mystery. It's a mechanism. And once you see it, you realize it's been running for years. Every reserve currency system works the same way at scale. First, the currency becomes indispensable. Trade settles in it, debt is priced in it, reserves accumulate in it. After World War II, the US dollar became that currency. By the 1970s, it replaced gold-backed systems entirely. By the 1990s, over 70% of global reserves were held in dollars. This gave the United States an extraordinary privilege. It could run deficits without immediate consequences. It could import more than it exported. It could finance wars, welfare, and crises by issuing debt the world was willing to hold. For decades, this worked, because global trade kept expanding. And surplus countries needed somewhere to park dollars, so they recycled them into U.S. Treasuries. That recycling was the hidden engine. In the early 2000s, China alone accumulated hundreds of billions in treasuries. By 2013, China held about $1.32 trillion. Japan held similar amounts. Oil exporters added more. At its peak, foreign holders owned over 35% of U.S. marketable debt. This mattered more than most people realized, because it meant U.S. deficits were externally absorbed. The cost of borrowing stayed low. Yields stayed compressed. Risk felt manageable. But here's the structural problem. Every dollar held abroad is a claim on future value, and those claims compound faster than real production, faster than domestic savings. By the 2010s, U.S. federal debt passed $20 trillion, then $25 trillion, then $30 trillion. At the same time, economic growth slowed structurally, productivity gains flattened, demographics worsened, the gap widened. More claims, less real backing. At first, nothing broke. Confidence filled the gap. Liquidity smoothed the math. Central banks expanded balance sheets. After 2008, the Federal Reserve introduced quantitative easing. By 2020, its balance sheet exceeded $9 trillion. This wasn't optional. It was required to keep the system functioning. But every intervention has a cost. It increases supply of currency. It dilutes purchasing power. Foreign holders notice this first, not emotionally, mathematically. If you're holding trillions in reserves, a 2-3% annual erosion matters. That's when behavior starts to change. Not suddenly, gradually. China did not wake up one day and sell everything. It slowed reinvestment. It let bonds mature without replacement. It diversified quietly. From 2013 onward, China's Treasury holdings trended down, year after year. No announcement, no confrontation. By the early 2020s, the trend was undeniable. At the same time, global reserve growth slowed. IMF data shows dollar reserve accumulation peaking around 2014-2015. After 2021, growth flattened. Some years turned negative in real terms. This is the critical transition. Not selling, non-buying. When the marginal buyer stops showing up, the system changes character. Supply still exists, but absorption must be incentivized. That's when yields rise structurally. That's when policy becomes reactive. That's when deficits start to feel heavy. This phase always confuses observers, because nothing dramatic happens. There's no collapse, no currency crisis, just pressure building, higher interest expense, greater dependence on domestic buyers, more frequent interventions. This is not failure, it's late-stage functionality. Rome debased silver to fund obligations. Britain printed sterling to sustain empire costs. The U.S. expands balance sheets to finance deficits. Different tools, same mechanism. Once the reserve system reaches this stage, the outcome is not debated. Only the speed is, and this is where the next phase begins. This is where awareness diverges, not between countries, between participants. The public reacts to events. Large capital reacts to signals, and signals started flashing years ago, not on television. In balance sheets, in flow data, in positioning. By the mid-2010s, large institutions could see the math. U.S. debt was accelerating. Foreign absorption was slowing. Central bank balance sheets were doing more of the work. That combination never lasts. So positioning began to change, quietly, institutionally. Look at asset managers first. Between 2018 and 2020, during the height of U.S.-China trade tensions, major U.S. financial institutions increased exposure to Chinese markets. BlackRock launched multiple China-focused funds. JP Morgan received majority ownership approval for its China securities business. Goldman Sachs expanded onshore operations. This was not political alignment, it was capital recognition. China was still recycling less into treasuries, but attracting capital directly into assets. That shift matters, because it bypasses the reserve system entirely. Now look at central banks. Since 2018, central bank gold purchases accelerated sharply. In 2022 alone, central banks bought over 1,000 metric tons of gold, the highest annual total on record. In 2023 and 2024, purchases remained historically elevated. This is not speculation. Central banks don't trade momentum, they hedge structure. At the same time, the share of dollars in global reserves declined, from over 71% in 1999 to around 58-59% in recent IMF data. That change didn't happen in 1 year. It happened through dozens of small reallocations. No announcement required. Now look at capital duration. Large funds shortened exposure, less long-dated sovereign debt, more liquidity, more optionality. This shows up in Treasury market behavior. Primary dealers were forced to absorb more issuance. Foreign participation became less reliable. Auction tails became more frequent after 2021. Not failures, warnings. Funding markets reflected the same shift. Repo volatility increased episodically. Collateral scarcity appeared where abundance once existed. That's not sentiment. That's balance sheet constraint. And then there's China itself. China didn't just reduce treasury holdings. It built alternatives. By 2024, China had signed currency swap agreements with over 40 central banks, covering trillions of dollars in potential settlement. Its cross-border interbank payment system expanded steadily, not to replace the dollar overnight, to reduce dependence at the margin. That margin is where recognition matters, because systems don't break at the center. They erode at the edges. This is what recognition looks like. No exits slammed, no speeches made, just capital repositioned before explanation was necessary. The population never sees this phase clearly, because it looks like normal business. Fund launches, risk management, diversification. But direction matters more than labels, and the direction was consistent. Away from long-term dollar claims, away from reliance on one settlement system, toward assets, inputs, and control. This is not disloyalty, it's literacy. Those who understand monetary history don't argue with structure, they adapt to it. By the time the conversation reaches the public, the recognition phase is already complete. Positioning is done, exposure is adjusted, and the system is left to explain pressure as if it appeared out of nowhere. This is where the mechanism arrives in real time, not as theory, as numbers, as flows, as pressure. China's U.S. Treasury holdings are now under $700 billion, down from $1.32 trillion at the 2013 peak. That is over $600 billion no longer recycled into U.S. government debt. But the larger story is not the sale, it's the absence. Those dollars used to come back automatically. They don't anymore. At the same time, U.S. borrowing has exploded. Federal debt surpassed $33 trillion. Net Treasury issuance exceeded $1.7 trillion in 2023 and remains elevated in 2024 and 2025. More supply is hitting the market, but the buyer structure has changed. Foreign official buyers are no longer the default absorber. Data from the Treasury International Capital System shows foreign demand becoming inconsistent and episodic. Some months positive, some months negative. No longer dependable. That gap must be filled domestically, which means higher yields. The 10-year Treasury moved from near 0.5% in 2020 to above 4.5%, despite slowing growth. This is not optimism. It is compensation for absorption risk. Interest expense tells the same story. U.S. federal interest costs are now over $1 trillion annually, rising faster than defense spending. That is structural pressure, not cyclical. Now look at the Federal Reserve. Its balance sheet peaked above $9 trillion. Then quantitative tightening began. Over $1 trillion in reserves were removed. Liquidity that once backstopped markets is no longer expanding. It is contracting. This matters because reserve systems rely on surplus liquidity. Without it, stress migrates into repo markets, into dealer balance sheets, into auction dynamics. Treasury auctions increasingly rely on primary dealers. Bid-to-cover ratios soften. Auction tails appear more frequently post-2021. Not failures, signals. Now zoom out globally. According to IMF data, the dollar's share of global reserves has fallen from over 70% in the early 2000s to around 58 to 59% today. That decline represents trillions in reallocation, not into one alternative, but across many: gold, local currencies, regional trade settlement, swap lines. China has signed currency swap agreements with more than 40 central banks, covering trillions in potential liquidity. Its cross-border interbank payment system continues to expand, not to replace the dollar overnight, to make the dollar optional. That optionality is the shift. This is where the $5 trillion number lives, not in a single transaction, but in changed behavior across global reserves, sovereign portfolios, and capital recycling assumptions. When reserve growth slows, when reinvestment pauses, when defaults change, the burden shifts inward. The U.S. must absorb more of its own debt. Policy must do more work. Intervention must be repeated. Nothing collapses. Everything strains. This is why markets feel different now. Why liquidity feels conditional. Why pressure replaces ease. China did not cause this alone, but its move accelerated recognition by removing the buyer that the system quietly depended on. This is the present, not a warning. A condition, and conditions persist until structure changes. This is where the data stops being abstract and starts asking a question. Nothing has collapsed. Markets are still open. Treasuries still trade. The dollar still clears global transactions. But look at what has changed. China reduced over $600 billion in Treasury exposure. Global dollar reserve share fell from over 70% to under 60%. Central banks bought record amounts of gold, more than 1,000 tons in a single year. Swap lines replaced settlement. Local currencies replaced default clearing. U.S. interest expense crossed $1 trillion annually. Yields rose not on fear, but on compensation. Liquidity did not disappear. It became conditional, and that is the key distinction. Reserve systems do not fail when money vanishes. They fail when holding becomes optional, when recycling slows, when confidence demands yield, when absorption must be incentivized. This is not a sudden event. It is an accumulation of small decisions, made independently, rationally, over years, by central banks, by institutions, by surplus economies, by anyone holding claims on the system. The $5 trillion shift is not a sale, it is a behavioral change. And behavioral changes do not reverse easily. They persist, they compound, they redefine what feels normal. This is not about China winning or America losing. Those are narratives for later. This is about structure. And structure does not care about narratives. History shows this clearly. Every reserve system lasts until the incentives that supported it change. Not when panic arrives, when indifference does, when holding becomes a choice, not a necessity. By the time this feels obvious to everyone, the adjustment is already complete. The assets have moved. The assumptions are gone. The pressure is permanent. This is not prediction. This is pattern recognition. History does not repeat. It executes. The only question is whether you recognize the shift while it was still quiet. Nothing has collapsed. And that's the point. China reduced hundreds of billions in U.S. debt. Global reserves stopped compounding the same way. Central banks shifted behavior. Liquidity became conditional. Pressure replaced ease. This wasn't a crash. It was a withdrawal of assumption. And systems don't break when money disappears. They break when support becomes optional, when holding requires compensation, when recycling slows quietly. By the time this feels obvious, the adjustment is finished, the assets are already positioned. The pressure is already priced. This is not prediction, this is pattern recognition. History does not repeat, it executes.